So, when we talk about the pricing of assets and we start looking at what determines what Bitcoin is worth, or what is Ethereum worth, or why is it that when Bitcoin dumps, Ethereum dumps, we have to understand something that Richard Hart has coined, Hart's Law. So, this video moving forward will discuss many of the dynamics of Hart's Law. We'll try to keep it simple and easy to understand, but what I'd most like to have you take away from this is a better appreciation for why it seems that the market moves together. Is it simply that everybody is like-minded and everybody buys and sells at almost the same time? Is it some massive manipulation, some invisible hand that's changing these prices based on their own vested interests? And I think what you'll find is that the better you understand the dynamics of Hart's Law and bonded liquidity, the easier it'll be to identify opportunities and to avoid fears in misplaced ideologies. So the pictures here on the screen, you can see the logo for Hex. Next to it is the USDC logo, and next to that is Ethereum. You've got Bitcoin, you've got the logos for several sovereign nations' monetary currencies, and then on the right there, in that purple circle, just kind of imagine your favorite ERC20 if it's not Hex. And the reason for for these images here, and also the sizes of these images, is to help you understand which assets are most responsible for backing the value of the assets that you're familiar with. So if you were to look at the liquidity pools that establish the price of Hex, the thickest liquidity is a pair between Hex and USDC. Next, there is also a liquidity pairing for Hex and Ethereum, which is not uncommon. Almost every ERC20 has a strong portion of its liquidity backed by Ethereum. What makes Hex a little bit different is that it's significantly thicker with liquidity in the USDC pairing. And moving forward, you'll see why that's kind of an interesting value proposition for Hex. Because if we go ahead and we look at Bitcoin, Bitcoin is actually paired thickest in liquidity, or bonded in liquidity, by Ethereum. It's also very common that it's bonded to currencies, because Bitcoin is now traded on centralized exchanges which accept fiat, and so there's a strong bonding of liquidity between US dollars, euros, Japanese yen, what have you. And your favorite ERC20 is most likely bonded to Ethereum. So then you might ask, why is this big Bitcoin sort of looming in the background, watching over this pairing? And the answer lies in the relationship of the liquidity of Bitcoin and Ethereum. An overwhelming amount of liquidity between Bitcoin and Ethereum is paired together. When Bitcoin dumps, it has a negative price effect on all of the value of the liquidity pools that are bonded by the value of Bitcoin. Well, if Ethereum is one of the thickest liquidity pairs of Bitcoin, then that means that when Bitcoin dumps, Ethereum tends to dump. The differences in how much they dump is a factor of supply and demand in the market in terms of who's buying and selling which asset, and it's also a factor of the alternative liquidity pools that explain the relative values between tradable assets, such as currencies that you're familiar with, world currencies, right? Dollars, for instance. And so when Bitcoin pumps, typically Ethereum pumps. There's also an the inverse. If Ethereum were to pump or decline in price, it's most likely to immediately affect Bitcoin. Now, on the far right, we can see that given the fact that most ERC20s come into the market and establish liquidity with Ethereum, which is the native asset to the Ethereum blockchain, what inevitably becomes a derivative value factor is that Bitcoin and Ethereum are so largely bonded together by their liquidity. So imagine that if Ethereum dumps, sure, your ERC20, which is usually paired pretty significantly with Ethereum liquidity in a pool, it's likely to dump with Ethereum. But there's also the reality that when Bitcoin dumps, it's going to have that negative price force on the price of Ethereum, which transitively has a negative price force on your ERC20 that's bonded in liquidity to Ethereum. And that's why it seems like every time Bitcoin dumps, all these altcoins and especially shitcoins dump with it. It's not because there's one or two or three enormous whales in the world that are buying up and selling off all the assets at the same time. It's simply a factor of the relative value and arbitrage opportunities of bonded liquidity. So if you had an opportunity to exchange your Bitcoin for an alternative asset that had not been directly impacted by the change in liquidity value, you would presumably always move your capital to a place where it had not yet been affected by the transitive property of bonded liquidity. Well, arbitrage rarely, if ever, exists in efficient markets, and so what you instead have is the representation of this invisible hand when the bonded liquidity is impacted and arbitrage is essentially cleared away by things like automated market makers, as well as the centralized exchanges, which have an obligation then to align their assets in such a way that they cannot be taken advantage of for discrepancies in prices across exchanges. And so that is essentially a high-level look at Hart's Law. When assets that are bonded in liquidity, when one moves, it has a similar correlated price effect on the asset it's bonded to. Hex does have a little bit of its liquidity bonded to Ethereum. The larger liquidity pool is in USDC. And so even when Ethereum dumps, it doesn't have nearly the impact that most ERC20s feel in terms of price. And when Bitcoin dumps, it's yet again only a derivative of the overall value of the liquidity pool that backs the value of Hex as an asset. So that's why we're able to see some really interesting price performance. Right here you have, this is about 2 days old, but it's the monthly chart, or I'm sorry, the previous month price performance of Ethereum there in the top left, Bitcoin in the top right, Litecoin in the bottom left, and Shiba Inu in the bottom right. And I pulled these 4 charts simply because they have some of the largest user bases in terms of transactions per day. And you can see a very easy to identify pattern. For starters, all of the charts begin towards the top left quadrant and end towards the bottom right quadrant. Anyone who's invested any amount of money and time in markets would understand that that is a loss of value over time. But you can also see a lot of similarities in where the biggest movements occurred, and even very similar shapes. So if we look up here and we get this kind of M shape that drops down, we have almost the exact same shape between Ethereum and Litecoin. Here's that shape again, maybe a little differently in Bitcoin. It's almost like 2 M's representing that same time horizon. Maybe not as easy to see here with Shiba Inu, which is considered an altcoin, but we do still get this pretty drastic spike down, which we can see in all 4 charts. Well, Ethereum and Bitcoin are bonded in liquidity. Litecoin and Bitcoin are bonded in liquidity. Shiba Inu and Ethereum are bonded in liquidity. Bitcoin is probably the most liquid asset, and so if the value of Bitcoin is diminishing, it will have a direct impact on the value of all other assets whose liquidity is bonded to Bitcoin. So that's how you kind of get this image where it's almost as if one person is making all the buys and sells in this market, but in reality it's simply the bonded liquidity having a transitive value property across changes in either asset or any asset. Here's the price of Hex over that exact same time frame. Let's begin with the easiest analysis, right? This chart begins in the bottom left and it ends in the upper right quadrant. So immediately we can see a divergent price performance. There in the smaller window with the laptop, you can see this is the exact same time frame. There's no magic being done here. I just simply clicked the 1 month chart on TradingView just to pull up these prices and give you an idea. But this shows you that even while the overall crypto market is dumping, HEX doesn't seem to move in the same way. There are some similarities because, again, there is liquidity for HEX that is bonded to Ethereum, but when the majority of that liquidity for HEX is bonded to the USDC, and the USDC is a stable coin where one coin will always equal $1, you get the opportunity for HEX to operate as a zero correlated asset with regard to the greater market. If you were to go into legacy terms and you talk about firm specific risk versus systemic risk, this would be an example where the systemic risk for HEX is significantly lower than the systemic risk of virtually all ERC20s, as well as Bitcoin and Ethereum, because they are their beta is going to be more closely related in terms of price moving up or price moving down relative to one another, and HEX can, as we say, march to the beat of its own drum. So if I were able to give a call to action to all of the Hexicans and all of the liquidity providers and all of the crypto enthusiasts of the world, I would suggest that when Pulse Chain were to go live, that we listen to the words of Richard Hart and we seriously look at the opportunity to pair our ERC20 HEX, bridge it over into Pulse Chain, and pair it with HEX on the Pulse Chain in a liquidity pairing. And why would we want to do this? Well, by pairing a bridged Ethereum HEX with Pulse Chain HEX, you then bond the price movement of these assets in their liquidity pool. And so when the price of HEX on Ethereum moves up and down, it has a direct impact on the price of HEX on Pulse Chain. And we know that Ethereum has the majority of its liquidity bonded to USDC, and therefore if Bitcoin were to dump and Ethereum were to dump, there's still only that derivative proportional impact on the price of Pulse Chain HEX, because again, there is some liquidity in Ethereum with regard to HEX. However, imagine a world where you bridge HEX into the Pulse Chain and you pair it in liquidity to Pulse Chain HEX, thus moving their prices in tandem, and you create a liquidity pool for Pulse Chain HEX and, let's say, bridged in USDC. So Ethereum USDC that's bridged into Pulse Chain and bonded in liquidity to Pulse Chain HEX. That bridged USDC would still presumably have the value of roughly $1 per coin, and therefore you've established the same dynamic for HEX, but you wouldn't have to bring any Ethereum liquidity to the table. You could simply completely remove any correlation to the macro market, operate in a different blockchain ecosystem that gives you lower fees, higher throughput, more usability in terms of tokenomics, and all the things that you already love about HEX, while freeing yourself from any of the fears and oftentimes misconstrued as manipulative aspects of price with regard to the ebbs and flows of the macro market of crypto. And so that's what I would urge everybody to begin discussing, is when Pulse Chain goes live, we need to become a more educated crypto community, and we need to empower ourselves to make decisions that ultimately pump our bags, because that's what everyone is investing for, right? We're not in it for the technology if the technology makes us poor. We're in it for the financial freedom and the empowering opportunities to pursue our dreams and our entrepreneurial goals, and the technology helps us achieve those things. When we look at what the implications here are, if we can create an ecosystem where liquidity is bonded for Pulse Chain HEX as well as Ethereum HEX, and say bridged in USDC, or maybe one day a stablecoin that exists natively on the Pulse chain, then what we ultimately have is an opportunity for an asset that does not inflate at the same enormous speed as the US dollar, priced against the dollar, which always requires more of itself to purchase the same good as it purchased yesterday, in an asset that allows you to earn yield rather than be diluted by its own inflating supply, so that you end up with the price appreciation of both Ethereum Hex and Pulse Chain Hex simply versus a dollar that becomes weaker and weaker over time. One USDC will still always equal one US dollar, but the US dollar is being printed and inflates much faster than the USDC because the total supply of USDC is not equal to the total supply of US dollars. It's only the USDC supply is only minted every time another dollar is deposited into USDC. So vis-a-vis, you escape the inflationary forces of the dollar while still earning the benefit of price appreciation relative to the depreciating dollar. So that being said, if you achieve this kind of strategy with regard to bonded liquidity, you exist in a world where you can now purchase your Pulse chain. Maybe you have ERC version of USDC, you bridge it in to the Pulse chain, and you swap that on Pulse X for Hex on the Pulse chain. Making that purchase would be an increase in demand, ceteris paribus, with regard to Hex and USDC, which would then pump the price for Pulse chain Hex and have a bonded liquidity positive externality of pumping the price of Ethereum Hex because of the relative values of the liquidity pools. So even if you didn't go out of your way to continue to buy Hex on the Ethereum network, just by setting up your liquidity pools correctly or for maximum advantage relative to the market, you can exist in a world where the acquisition of more Pulse chain Hex, actually pumps both your Pulse chain Hex bags and your Ethereum Hex bags. And so that's what I would urge everybody to start getting their mind kind of framed for, is the opportunity to maximize and utilize Hex on two chains with price appreciation, and along the way there can continue to be opportunities for recognizing relative value propositions with regard to different APYs offered by each asset, different ecosystem incentives and disincentives for things such as gas fees, and how that might impact your long-term price forecasting of either side of the asset. But that said, hopefully that brings you up to speed with a little bit of the game theory that can take Hex on Ethereum and Hex on Pulse chain and produce price appreciation that we've never seen before. We don't have the negative externalities of Bitcoin. We don't have the bonded issue with Ethereum and Bitcoin that most of the ERC20s in the world suffer from. We have this unique opportunity in time with PulseX going live to become masters of our own destinies and to align our liquidity pools in a way that really gives us the best path moving forward for our own investments.